For today, we will talk about another topic in your syllabus, which is your non-current assets. However, for this particular session, we talk about past 16, past 20, and past 23, particularly the acquisition of your non-current assets. The acquisition of non-current assets, or the acquisition of property, plant, and equipment. Okay? Property, plant, and equipment is governed under PAS 16. And one of the different modes of acquisition of your property, plant, and equipment under PAS 16 is your PAS 20 or your government grants. And another is your PAS 23, your borrowing costs, especially for your self-constructed asset. Especially for your self-constructed assets. So for this particular topic, we talk about your modes of acquisition, and then we also discuss past 20 and past 23. Just like any other standard that we have discussed before, this particular session, we talk again about your recognition and your measurement. Recognition and your measurement. So let's start with property, plant, and equipment. So what is a property, plant, and equipment? So under this standard, a property, plant, and equipment is defined as this way. First, it must be held for use in the production or supply of goods or services, for rental to others, or for administrative purposes. Therefore, your property, plant, and equipment, it has three uses. First, it can be for production or supply of goods and services. Another, it may be used for rental to others. And another, it may be used for administrative purposes. So this particular property, plant, and equipment, it must be used. It must be used by the entity or by the company. Because if that particular property, plant, and equipment is held for sale, you can either place it as PFRS 5 if it is a non-current asset held for sale. But if it's held for sale in the ordinary course of the business, then you can use it under PAS 2 inventory. But take note, under PAS 16, what distinguishes it from the two other standards that we have already finished, or from PFRS 5 or PAS 2, is that the usage here is not for sale. The usage is for the use mainly of the entity. That is either for production or supply of goods or services, or for rental to others, or for administrative purposes. So there are three uses under PAS 16. Now take note, for rental to others, later when we talk about your PFRS 16 leases, we will talk that if ever your lease is that there will be a transfer of ownership. Again, under PAS 16, if you held your PPE for rental to others, under PFRS 16, if there is a transfer of ownership, we will recognize that particular property, plant, and equipment. That is under your PFRS 16. Okay? So soon when we go to PFRS 16 leases, we remember this one. If we are the lessor, if there is a transfer of ownership, we need to recognize that asset. Okay? But for now, let's just take note that under PAS 16, if you are holding the property, plant, and equipment for rental to others, then it can be used or placed under PAS 16. Later also, when we go to your PAS 41, if you have a particular asset which is land or building, which is held for rental to others, can also be recognized under PAS 41 as investment property. So for now, you know that property, plant, and equipment can either be under PFRS 5 if it is held for sale or a non-current asset held for sale. Another, it can be under PAS 2 if it is held for sale in the ordinary course of the business. It can be under PAS 16 if it is for production or for rental to others or for administrative purposes. Another, it can be under your leases, PFRS 16. We need to recognize if there is a transfer of ownership. Another, it can be under PAS 41. If the property, plant, and equipment is a land or building and it is held for rental to others, it's called investment property. It is called investment property. Okay? So remember these different recognition principles under your property, plant, and equipment. So it doesn't mean that if that is a property, plant, and equipment, it will fall again on your PAS 16. So you need to know what particular purpose is the usage of the property, plant, and equipment. So it can be under PFRS 5, PAS 2, PAS 41, PFRS 16, and ultimately PAS 16. So remember our recognition criteria. It must fall on the definition. Remember, if you recognize an item, it must fall on the definition of that particular item. So if it falls to the definition of PAS 16, then it is PAS 16. When does it fall under PAS 16? If it is held for use on the three main purposes. Another definition, it must be expected to be used for more than one period. Okay, so if ever it's held for use and used for more than one period, it is known as a property, plant, and equipment. Sir, what is the use of that particular definition added on a property, plant, and equipment that it must be used for more than one period? Because normally, a property, plant, and equipment is a long-term asset. So when we say it is a long-term asset, it must benefit future periods. So it must benefit more than one period. That's why under PAS 16, it was defined to also expect as a particular asset to be used for more than one period. So remember this definition under PAS 16, it is held for use and it is expected to be used for more than one period. So what are the characteristics of a property, plant, and equipment? So the first characteristic is it is tangible. So when we say it is tangible, it is capable to be touched. Why? Because if it's held for use and expected to be used for more than one period, and then it is tangible, it is PAS 16. But it is held for use for more than one period, and it is considered intangible, then it is an intangible asset under PAS 38. Again, one of the characteristics of your property, plant, and equipment under PAS 16 is it is tangible because, again, the definition, it is held for use and used for more than one period. It must be capable of being touched so that we can say it is under PAS 16. Because if that is an intangible, under the standard, intangible asset is also held for use and it can be used for more than one period. So what differentiates a tangible asset to an intangible asset? So under PAS 16, it must be capable of being touched. While under PAS 38, it is incapable of being touched. So it is an intangible asset under PAS 38. Okay? So PAS 16 tangible, if it's tangible, or if it is intangible, PAS 38. Another characteristic is it is used in operations. You already know. When we talk about using your operations, it can either be for production or supply of goods or services, for rentals, or for administrative purposes. And lastly, it is a long term. So why is it again long term? Because it is again expected to be used for more than one period. So what again are the characteristics of property, plant, and equipment? First, it is tangible. Next, it is used in operations. Lastly, it is a long-term asset. So when do we recognize a particular property, plant, and equipment? Just like those items that we have finished, we recognize a property, plant, and equipment if it is probable that there will be future economic benefits, and you can measure it reliably. But take note, aside from this, it must meet the definition under PAS 16. So under PAS 16, what is the definition again? It must be for use in the operations, or it must be for your goods or supplies or services, rental to others, or for administrative purposes. And it must be used for more than 1 year. Okay? So again, what is the recognition criteria under your PAS 16? To recognize an item as property, plant, and equipment under PAS 16, it must be probable, it must be measurable, and lastly, it must meet the definition of a particular property, plant, and equipment under PAS 16. Now, how do we measure it? How do we measure it? So to measure it, first we measure it by our purchase price. So we already know what is a purchase price. That is the price or the cost of a particular asset. Next, we have your directly attributable cost. So what is a directly attributable cost? A directly attributable cost are your costs necessary for the present location and condition of the asset. Okay? So a directly attributable cost was also already discussed to you when we talk about your PAS2. So purchase price plus directly attributable cost. And lastly, plus initial dismantling cost. So what is an initial dismantling cost? An initial dismantling cost is the cost to remove the asset at the end of its useful life. Sir, why does it mean initial? So why is the term initial? So we know what is a dismantling cost. Dismantling means to remove. So the act of removing that particular asset. So why do we say it is initial dismantling cost? So this one, since it is a future cost, meaning it is a cost to be incurred in the future. And what is that future? That is the end of the life of the asset. Right? That is the end of the life of the asset. It is known as initial dismantling cost because this future cost is only an estimated cost. So since it is an estimated cost, you get for the present value of the dismantling cost. If the question is, what is the initial measurement of your dismantling cost? It is measured at your present value. Sir, why do we need to measure it at the present value? Because it is a future cost. You need to know the cost at current date. You need to know the cost at the current date. So it is a future cost. You need to know the cost at the current date. To get the cost at the current date, it is known as present value. So get the present value of dismantling cost. Why is it again a future cost? Because you will only incur it at the end of the useful life of the property, plant, and equipment. Okay, so we're done with your recognition. It must be probable and measurable. We're also done with your initial measurement. It is your purchase price plus directly attributable cost plus initial dismantling cost. Okay? So you already know what is the purchase price. That is the cost or the price of the asset. Directly attributable costs, that those are the costs necessary for the present location and condition of the asset. And then we have your initial dismantling costs. These are the costs to remove the asset at the end of its useful life. So to measure that initial dismantling cost, you get the present value of the dismantling cost. Now we look into the different modes of acquisition of property, plant, and equipment. So when we talk about modes of acquisition of property, plant, and equipment, these are the different modes to get or acquire that property, plant, and equipment. So generally, what we look here is your acquisition cost. So the first mode is cash. So when we say the first mode is cash, it means that you purchase or acquire the property, plant, and equipment through cash. You purchase the property, plant, or equipment or PPE using cash. So when we say you acquire it through cash, what is the acquisition cost? The acquisition is your cash price. So whatever is the cash price paid, that is your acquisition cost. Another, if you purchase your property, plant, and equipment on account. So when we say on account, generally, this is your accounts payable. So your entry here is debit, property, plant, and equipment, credit, accounts payable. So if you measure your property, plant, and equipment, or you purchase it on account, you get it net of discount, whether taken or not. So you get it net of its discount, whether taken or not. So what do we talk about this discount? This is your cash discount. Take note, whether taken or not. So you will record your property, planner, or equipment the acquisition price is net of discount, whether taken or not. So for example, we have 90,000, 210, and 30. What is the measurement of your property, plant, and equipment? So we said we will measure it net of discount, whether taken or not. So that is 90,000 multiplied by 98%. Why is it 98%? Because 90,000 is 100% and 2% here is the discount. So you will deduct the discount already, whether you will take it or you will not take it. Another mode of acquisition of property, plant and equipment is your long-term financing. So in this mode of acquisition, you will issue long-term finances. So what are your long-term finances? Generally, you issue your note payable or your loans payable or your bonds payable. So the following are your long-term finances. So when we say you acquire your property, plant, and equipment using long-term financing, what did you issue? That is either notes, loans, or bonds. Now the question is, what is the acquisition price if ever you acquire your property, plant, and equipment using long-term financing? The acquisition price is the present value of cash payments or the cash price equivalent. The present value of cash payments or cash price equivalent. So when we say present value of your cash payments, that is the cash payments, cash, pays, cash payments discounted at the market interest rate. So generally, when we talk about your present value of cash payments, that is your cash payments discounted at market interest rate. So generally, if this is your cash payment, 200,000, 200,000, and 300,000, you multiply them to your present value factor. Your present value factor is based on your market interest rate. Soon on your higher accounting, you will learn how to compute for that present value factor or the cash price equivalent. So when we say cash price equivalent, that is the cash price if not acquired through financing. So for example, you issued 200,000 non-interest bearing note. The market interest rate is 5%. If purchased through cash price, you will only pay 180,000 pesos. So when we say you measure it long-term financing, that is either present value or cash price equivalent. So in this example, the cash price is 180. So you use the cash price equivalent, which is 180,000 pesos, meaning that is the cash price if not acquired through financing. Okay? So if that's long-term financing, what is the acquisition again? What is the acquisition cost? That is either present value of cash payments. These are your cash payments discounted using the market interest rate. You know this one as your present value factors or the cash price equivalent or the cash price if not acquired through financing. Another mode of acquisition of property, plant, and equipment is your purchase at a basket price. So when we say it is a purchase at a basket price, these are different property, plant, and equipment purchased at a lump sum price. So for example, so you have your land, we have your building, and we have your machinery. So these three items were purchased for one price, that is 1.5 million pesos. We call that as a property purchase at a basket price. So if a property is purchased at a basket price, the main question here again is how will we measure the property, plant, and equipment? We measure it at either relative fair value if all fair values are known, or residual if there are those items that we do not know their fair value. Okay? Relative fair value if we all know their fair value, or residual if there are those items you do not know their fair value. So for example, we use your relative fair value. So our total basket price is 1.5 million. So assuming the fair value of your land is 800,000, the fair value of your building is 150,000, and the fair value of your machinery is 50,000. So that is your fair value. You purchase it at 1.5 million. So in a relative fair value, you will allocate the total basket price using their fair value. So you allocate 1.5 million to your land using its relative fair value. So what is the fair value of your land? 800. What is the total fair value? 800 plus 150 plus 150. That is 1 million. So 800,000 over 1 million. That's how you will allocate. For building, so 1.5 million, the total basket price, you will again allocate it based on the relative fair value of the building. That is 150,000 over 1 million. And for machinery, that is 1.5 million multiplied by 50,000 over 1 million. So that is how we will do your relative fair value. We allocate the total price to the fair value of the property, plant, and equipment. So 1.5 is allocated based on the fair value of the land. 1.5 again is allocated using the fair value of the building, and 1.5 is allocated again using the fair value of your machinery. That is your relative fair value. Take note, all fair values must be known using relative fair value. How about your residual fair value? In your residual fair value, some fair value are known and some are not. So for example, we have your land, we have your building, and we have your machinery. So our basket price again is 1.5 million, and the fair value of your land is 1 million. The fair value of your building is 280,000. But your machinery, the fair value is unknown. Under residual, you first allocate to those with known fair value. So you allocate 1 million to land because its fair value is known. Another, you allocate to building because its fair value is known. So when we say residual, whatever is left to the unknown. Whatever is left to the unknown. So for machinery, what is left? So 1,280,000, this is 1,280,000. We have 1.5. We have 220,000 that is left. So whatever is left, you will already allocate it. So 220,000, that is the residual, you allocate it to your machinery. So you only use your residual approach if some of the fair values are known. If all of the fair values are known, then relative fair value, some residual approach. Okay? Purchase at a basket price, meaning you purchase different sets of property, plant, and equipment at a lump sum price or a basket price. So as you can see here, your land, building, and machinery is purchased at a lump sum price, which is 1.5 million pesos. Next, issuance of shares. So when we say you purchase your property, plant, and equipment using the issuance of shares, you issue your own equity shares to purchase property, plant, and equipment. You issued your own equity shares to purchase property, plant, and equipment. So in the issuance of shares, the measurement is in the order of this priority. First, fair value of your asset. Next, fair value of your shares. Next, par value of shares. Sir, what is that fair value of asset? Fair value of your asset received, fair value of shares issued, and par value of shares issued. So for example, so purchase property, plant, and equipment with fair value of 3 million pesos, 200,000 shares were issued with par value of 5 pesos per share with fair value of 13 per share. Okay. So purchase PPE with fair value of 3 million. 200,000 shares were issued with par value of 5 per share and fair value of 13 per share. So what is the fair value of asset received? That is 3 million. What is the fair value of shares issued? So we have here 200,000 shares issued at 13 pesos per share. So this is 2.6 million. And the par value of shares issued is 200,000 times 5 pesos per share. That is 1 million. So when we say you issued shares to purchase the property, you measure it in order of priority. So if the fair value of asset, if fair value of asset received is given, use that one. If not given, then use fair value of shares. If this is not again given, then use your par value of shares. So when we say in order of priority, you follow a certain hierarchy. That if this one is given, use it. If not, use this one. If not, use this one. Okay? So again, if fair value of asset is given, use this one. If not given, use the second priority. If not, again, given the first and second priority, use the third priority. Okay? So you have here a hierarchy. You just follow the hierarchy. What is the hierarchy? Asset received, shares issued, par value of shares issued. So mode of acquisition, you issue a share to receive a property, plant, and equipment in return. Another mode of acquisition of property, plant, and equipment is the issuance of bonds. So in your issuance of bonds, here you issue bonds payable. You issue bonds payable. So again, it is in the order of priority. It is in the order of priority. That is again your hierarchy. So first, fair value of the bonds. Generally, your fair value of the bonds is the present value. So if you still remember a while back, you will issue it at the present value. So what if the present value is not given or the fair value is not given? Then fair value of the asset received. Then lastly, par value or face value of the bonds. So take note of this. A while back, we have your issuance of shares. So what is your priority there? The fair value of asset received, fair value of asset shares issued, and lastly, par value. Here, it is the fair value of bonds first, and then the asset received, and the par value or face value of the bonds. So please do not interchange the order of priority for the acquisition of property, plant, and equipment as your issuance of bonds and your issuance of shares. Okay, take note of our hierarchy. Next mode of acquisition of property, plant, and equipment, we have your exchange. Okay? So your exchange, meaning there is a property, plant, and equipment of one entity and another property, plant, and equipment of another entity in which you will now exchange those property, plant, and equipment. Okay, so your exchange can either be without commercial substance, so without commercial substance, or with commercial substance. So first, what is a commercial substance? So if there is a difference as to the future economic benefits of the property exchange, there is a commercial substance. So if there is a difference as to your future economic benefits or to your cash flows, particularly because of the exchange of the property, plant, and equipment, then we have a commercial substance. So if there is an exchange without commercial substance, you will measure the property received. The property received is measured at fair value or book value of asset given up. Okay. So here you have property received and property given up because it is an exchange. If you receive something, you will give up something. The question here, your mode of acquisition is, of course, what did you acquire? The new property received. So how will you measure it? You measure it at the book value of the asset given up. So there is no gain or loss in an exchange without commercial substance. Take note of that. There will be no gain or loss if the exchange is without commercial substance. But if the exchange is with commercial substance, you will measure it first at the fair value of asset given up, if that is given. If not, then fair value of asset received, then fair value of asset given, book value of asset given up. So again, we have here a hierarchy. So together with this hierarchy, you add your cash paid, you deduct your cash received. Okay, so in an exchange, remember this one. Since there is an exchange, there are two property, plant, and equipment that is concerned in this transaction. That is your property received and your property given up. So the question is, how will you measure the property received? If that is without commercial substance, you will measure it at book value of asset given up. But if that is a with commercial substance, you either measure it the fair value of asset given up, fair value of asset received, or book value of asset given up. Last cash payment, less cash received. And take note, if there is a commercial substance, there is a gain or loss. Why? Because you can either measure it at the two items. Here, you just debit the property, plant, and equipment again at the book value, and then you credit the property, plant, and equipment given up at the book value. So you debit the property, plant, and equipment received at book value, the property, plant, and equipment given at book value. Since it is book value and book value, there is no gain or loss. They are equal. But here, you debit your property, plant, and equipment received at either fair value of the asset given up, asset received, or the book value of asset given up. Since there is now a difference, this is measured at fair value, and the PPE given up is always measured at book value. So the difference between the fair value and book value is the gain or loss. So here, there is now a priority to measure the property, plant, and equipment received. Since there is now a priority, there will be a difference of that amount based on the priority and the book value of the asset. So the difference is known as gain or loss. Take note, if that is without commercial substance, there is no gain or loss. If with commercial substance, there is a gain or loss. Take note, we have a hierarchy. Fair value of asset given up, fair value of asset received, and book value of asset given up. That is in case of exchange. That is in case of exchange. Another mode of acquisition of property, plant, and equipment is a trade-in. However, in an exchange, particularly whatever is the value of the asset exchange, you get the same. However, in trade-in, aside from the asset exchange, you must pay a certain amount. So still, you will measure it in the order of priority. That is your asset given up and your asset received. However, for your fair value of asset received in a trade-in, how do we measure it? That is known as your cash price without trading. Your fair value of asset received is known as your cash price without trade-in. Okay? So normally we have your cash price plus trade-in because, of course, you need to pay aside from your asset traded in. But in your fair value of asset received, so that you can measure it, that is cash price without trade-in. So you just need to know the amount of your asset received. So cash price without trade-in. I don't know if ever you have already came into or met at least a trade-in. So I think this is still prevalent nowadays. You need to you trade in your cell phone and then you pay a certain amount and you get a new one. So that is considered a trade-in. I don't know if ever you have experienced it or you know about it. So a trade-in of cell phone, which is very prevalent nowadays. So it is the same as exchange, but aside from giving your cell phone or your property, you will pay a certain amount. Okay? So the certain amount is known as your cash price. Another mode of acquisition of property, plant, and equipment is your donation. So your donation can either be unrelated, meaning not coming from entities related to the company, or it can be related such that it comes from stockholder. So let's first talk of your donation from a stockholder. On a donation of a property, plant, and equipment from a stockholder, it is measured at the fair value of asset received. Why? Because this one is a unilateral item. This is more of a gratuitous transfer. A while back in your exchange, there is one property and another property. Okay? So it is a bilateral transfer. So generally onerous. While in your donation, we have here the entity and we have here other entity. So it is only unilateral. The other entity donates to our company. So we are this one, we are this company, and the other entity will donate to our company. So it is unilateral, purely gratuitous. So since it is gratuitous, you did not give up anything. You did not give up anything, no asset given up, but you have received something. So since you only received something, how will you measure it? At the fair value of your asset received. So since you only received something, you will measure it based on the fair value of asset received. So your entry is generally debit to PPE and you credit it to donated capital. So remember, if there is a donation from the stockholder, it will go in your donated capital. Sir, what is a donated capital? This is an item of shareholders' equity. This is an item of shareholders' equity in which this item of shareholders' equity is a part of your additional paid in capital. Additional paid in capital. Right? So donated capital is within your shareholders' equity, additional paid in capital. Just remember, if the donation comes from your stockholder, it will go to your shareholders' equity donated capital. It is considered an additional paid in capital. Okay, so that is a donation related stockholder. How about if donation unrelated? If that is donation unrelated from other unrelated parties, you still record it at the fair value of asset received. Sir, why do we need to record it at fair value of asset received? Take note, this is a donation. If that is a donation, you only have an asset received. You do not have an asset given out because it is unilateral. So whatever is the asset received, the fair value of that asset is the amount of your property, plant, and equipment. But unlike in your donation from a stockholder, your entry here is a debit to a property, plant, and equipment and a credit to your income. Okay? So if it is from a stockholder, your credit is a donated capital, an item of shareholders' equity. If it is from other unrelated parties, your credit is your income. Okay? Your credit is your income. We go now to another mode of donation. That is your donation from government. So if that is a donation from government, generally we call that your government grant. Okay? Donation from the government is known as your government grant, PS 20. Government grant, PS 20. So generally, PS 20 prescribes for the accounting and disclosure of your government grants and other government assistance. So if ever we acquire a property, plant, and equipment because of a grant from the government, we call that a donation or a government grant. Just take note, a government grant is recognized only if the entity will comply to the conditions of the grant and the grant is received. So there are two requirements for you to recognize a government grant. First, you comply with the conditions of the grant and the grant is received or receivable. Okay? So as I place here, remember, you will record the property, plant, and equipment that you acquire through a government grant only if your conditions are met. Therefore, these are the two items. Once you receive the government grant, no problem here with your government grant is received because normally you will always receive that. What's hard is the compliance with the conditions. So whatever are the conditions attached to the grant, you must comply them. So you will only recognize it as a government grant if you comply with the conditions and the grant is received. So generally, your grant can either be a grant related to asset or a grant related to income. So your grant, okay, so your government grant can either be a grant related to asset or a grant related to income. So when we say it is a grant related to asset, that can either be to a particular property, plant, and equipment. Grant related to income that is relating to your past expenses. Okay. So if that is a grant related to asset, particularly to a property, plant or equipment, land or building, you have two ways of presenting your grant related to asset. So what are the two ways of presenting your grant related to asset? That is either a deferred income or it is considered a deduction to the asset. Okay? So if that is a grant related to asset, you have two ways: deferred income or a deduction to the asset. Let's illustrate what is a deferred income and what is a deduction to the asset. So for example, you have a property, plant, and equipment which is worth 20 million pesos. And there is a government grant relating to that property, plant, and equipment which is 10 million pesos. So in short, it's as if the government subsidized 10 million out of that 20 million. So kung 20 million yung worth ng asset, kumbaga binigyan ka ng government ng 10 million para bilhin yung PPE na yon. So that is your government grant. So we have two items or two ways to recognize it. So we have your deferred income or deduction to the asset. In deferred income, we will match it over the life of the asset. We will match it over the life of the asset. So for example, the asset has a life of 5 years. Okay. So if this is 20 million, we have your government grant. Initially, we debit cash for the government grant that we have received, and then we credit deferred income from government grant, 10 million. So it is considered deferred. And you will match it over the life of the asset. So the life of the asset is 5 years. So you debit deferred income from government grant, you credit grant income for the life of the asset. So 10 million over 5, so 2 million, 2 million. That's how you will present it. So initially, in your income statement, you have here your grant income amounting to 2 million, but you also have your depreciation expense, which is equal to 20 million divided by 5. 20 million divided by 5 is 4 million, so you have net effect of negative 2 million. Okay? Deferred income from government grant. We will match it based on the life of the asset. So we have here PPE, for example, 20 million, and we have here government grant, 10 million for 5 years. Okay, so since it is for 5 years, what do? We will match it over the life of that particular asset. So initially, since we will recognize it as deferred income, your entry at the time of grant is debit grant, 10 million, or debit cash, 10 million, credit deferred income from government grant, 10 million. And then, as the life of the asset pass by, we will recognize a grant income. So debit deferred income from government grant, 2 million, and credit grant income, 2 million pesos. So in our income statement approach, so you have here recognized grant income of 2 million. And aside from that, we recognize the depreciation out of the 20 million. Okay? So that's how we will recognize a deferred income based on government grant. Next, we will recognize a grant from grant related to asset. Another mode is your deduction to the asset. So a while back, we have your deferred income. Now you have your deduction to the asset. So your property, plant, and equipment is 20 million, right? So how much is our government grant? 10 million. So directly, we will deduct that to the assets. So 20 million less 10 million. So we have here 10 million left. This is the value of your PPE. So how will we record that? To record that, we debit your cash, the amount of grant that we receive, and we credit the property, plant, and equipment, 10 million, because it is considered a deduction to the asset. Okay? It is considered a deduction to the asset. Now, in our income statement, we did not recognize a grant income, as you can see, because we directly deducted it to the PPE. However, for the depreciation, what is the depreciation? Since the net now is 10 million, 10 million divided by 5 years, so our depreciation now is only 2 million. The net effect is still 2 million. So regardless, if your way is deferred income or deduction to the asset, the net effect is the same. However, in your deferred income, the government grant is matched to the life of the asset, or you will recognize it over the life of the asset under your matching principle. So you will recognize it as income over the periods necessary to match them over the related cost. So you will match them over the related cost, or what that is the life of the asset. But on the other way, which is the deduction to the asset, you will directly reduce the amount of our grant. The amount of our grant is directly reduced to the amount of our property, plant, and equipment. So as you can see, our amount of grant of 10 million will reduce the PPE. So have here 10 million property, plant, and equipment net. So regardless, on your grant related to asset, you will record it either deferred income or deduction to the asset. You will get the same effect on your income statement. So take note, on your government grant, you will record it at fair value, but you will only record your grant related to the asset if you comply with the conditions and the grant is received. So that is under PAS 20 government grants. So we have two types of grant related to asset and grant related to income. Grant related to asset, particularly to a particular asset that can be recognized under deferred income or deduction to the asset. Another grant related to income, that talks about your expenses or past expenses. So the donation is now particular to your past expenses. So another mode of acquisition of property is a donation, government grant, which is now recognized under PAS 20. Okay, so I hope you understood PAS 20 under your donation or mode of acquisition of property, plant, and equipment.